iBuyers, institutional investors like BlackRock, and so-called mom-and-pop investors have been playing a major role in the housing market over the last several years. But as the market corrects and the cost of capital increases, the total number of investor purchases in the residential real estate market has basically fallen off a cliff. According to Redfin, investor purchases are down a staggering 49% from Q1 of 2022 to Q1 of 2023. And with investor activity dwindling, it brings up a lot of important questions like, could this lead to further price declines beyond the ones we've already seen? Will competition be lower and actually help out the investors who want to participate in this market? What asset classes and types of properties are investors, the ones who are still buying, what are they buying? And should you consider buying them too? And which regions are set to benefit the most from all this? In this video, we're going to address all of these important questions and more. But before we talk about it, let's just get real for a second. Look, we all look forward to actually going out and buying properties, but what will actually make or break your rental portfolio is property management. But luckily, you don't need to be an industry expert to manage your properties the right way. You just need RentRedi. RentRedi is the property management software that saves you time and money by streamlining your day-to-day. You can use it to collect rent, you can screen tenants, list units, sign leases, and manage repairs all in one place. New customers get 50% off any plan when you enter the code BPDATA at checkout at rentredi.com. You can sign up by just going to rentredi.com and use the code BPDATA, and again, that'll get you 50% off any plan. Okay, let's get into our investor activity deep dive, and we're going to start at the top and get a broad sort of historical look at how investors are involved in the housing market. As you can see in this first chart that I'm showing here, investor activity has been on an upswing for more than a decade. And if you remember, maybe you were around, maybe you don't, but if you look back at what happened in the great financial crisis, investors entered the market a lot in 2010, 2011, because they saw that prices were really cheap, and that really helped set the floor after the crash. This helped prices stop free falling. It set the bottom and set the stage for all the price growth that we've seen over the last 10 or 12 years. Activity was steadily picking up over the last decade, and it really reached this peak during the pandemic years where investors were buying over 90,000 homes per quarter for a little bit of while. But if you fast forward to today, you see that has dropped more than half from this last year to this year, and now investors are only buying about 41,000 properties per quarter. Remember, it was 90,000, now it's at 40,000. This is clearly a dramatic and pretty important drop to consider, but you also should know that it's not just investors who are pulling out of the housing market. All home sales have declined year over year. It's about 25% for the total market, but for investors, it was 49%. So while the volume overall is down, the proportion of home sales going to investors is not actually down that much. And that's also really important. If you look at this chart, you can see that investors' share of total home purchases peaked in 2021 at around 20%, but it's still around 18%. So this is above pre-pandemic levels, but down from the frenzied level that we saw during the pandemic. It's also worth noting that the number is stabilizing. It's been at about 18% of all home sale purchases going to investors for 3 straight quarters. Obviously, this could change, but it's been relatively stable through 3 quarters. So there's less buying overall, but investors are still making up a pretty good chunk of all the purchases. It's just that total purchases are down a lot. So the question then becomes, why are investors leaving the market? Well, first and foremost, rent growth is slowing, and taxes and insurance are a lot higher than they used to be, and it makes it more difficult to find cash flow. I'm sure anyone who invests in real estate sees this right now, that cash flow is difficult to find right now, and that is having some investors leave the market, at least temporarily, maybe permanently, I don't know, but at least temporarily. The second reason is that flippers are finding it more challenging to make money because many markets are declining. A lot of flippers, obviously want to make money through improving properties, but when appreciation and inflation are driving up prices, that obviously bolsters flippers' returns. And so, but they're not experiencing that in the same way as they were over the last couple of years. Actually, roughly 1 in every 7 homes, about 13%, sold by an investor in March sold for less than the investor bought it for. So losing money there, which is not good. And that is just shy of the 7-year high set in February. When you look at flippers, and the way that you identify this is a property that was bought and sold within 6 months. If you look at that data, you see that 21% of flippers lost money in the last month. So this is obviously not a great environment for people to be flipping. The third reason investors are leaving the market is probably obvious. It's just widespread economic uncertainty. Recession fears are also prompting investors to pump the brakes. They basically want to slow down and see what happens. Some investors might be moving their money into stocks or into bonds or into just other asset classes. Maybe they're holding it in cash right now, but they basically don't want to make a big financial decision like buying a property. That is just generally speaking. When you actually dig further into the data, you can see that not all investors are leaving the market. And depending on the investor's relative size, the activity really varies. So when you look at this data from CoreLogic, a very reputable firm, you can see a couple things going on. First, I think it's always telling, and people are always surprised by this, but smaller investors make up more market share, and they always have. If you look at this chart, you see what they designate as large investors and mega investors. And honestly, CoreLogic doesn't do a great job explaining what the difference between a mega investor and a large investor is. So I don't really know. But what you can see is that the small and medium-sized investors, however they define that, take up way more market share, like orders of magnitude bigger than mega and large investors. And I think that's just something people often overlook. They think BlackRock is dominating the market or Invitation Homes, and that activity has picked up. Don't get me wrong. They are getting more and more active, but they still make up a very small portion of investor activity in the US. Mom and pop, small investors make up the vast majority. In fact, the people who 90% of rentals are owned by people who own 10 units or less. So that's just something you should know. But what you can see here in terms of recent activity is that small and medium investors who make up the most share are actually getting back into the market. You can see that their activity level is picking up while the institutional investors are a little more hesitant and haven't jumped back into the market as quickly. I have found some additional evidence that confirms this data here. So Yield Street, which is a big real estate firm, they have come out and said that they have not bought any single-family homes in 2023. Invitation Homes, which is the largest landlord, single-family landlord in the country, was a net seller in Q1. So they sold more homes than they bought, but it was really just by a small margin. It was like a couple dozen homes. So it's not like that. They're not like fire selling their properties, but it is telling that they are selling more that they're buying. That's an important data point. But I think the biggest trend here and why we're seeing the biggest pullback in overall investor activity is iBuyers. If you haven't heard, iBuyers are things like Zillow, Opendoor, OfferPad. They're these companies that were buying properties sight unseen, like one click, you could just sell your property to them. And these companies got absolutely crushed in 2022. You saw Zillow completely exit the market. Big publicly traded companies like Opendoor took huge hits on their valuation following big losses. They are scaling back. iBuyer activity peaked at around 6% of all investor purchases a couple of quarters ago. Now it's down to 1%. So if you want to isolate who's pulling out of the market, it is mostly iBuyers. And, it's never that big of a factor. 6% of all investor purchases, again, not that big, but it's 1/6 of what it was. And so on a national scale, that matters a little bit, but on a local scale, it can really matter a lot. Like if you're in a market like Charlotte or Atlanta or Phoenix, where these iBuyers are super active, seeing them scale back is going to make a difference in your market, even if on a national level, it doesn't make as big a difference. So now that we can see that although investor sales are down, it's mostly the big players who are moving out while small and medium investors keep buying. So what are they buying? According to Redfin, they're mostly buying single-family homes and condos. Like single-family homes, that makes sense. It's always been the most popular rental property to buy, and it's still a good thing to buy. Condos is a little bit of a surprise to me, but maybe that's just because I don't like investing in condos. But I think it's probably an affordability thing. Condos are just cheaper, and in this really expensive market, perhaps that's what small and medium-sized investors can afford to purchase right now, and so that's why they're purchasing. But of course, investor activity is super regional, and what I've been sharing with you are mostly broad national trends. But if you look at investor activity on a statewide level, you can see that investor activity is highly concentrated concentrated in the South and Western regions of the country, as well as Middle America. As such, every region will be impacted differently by slowdowns in investor activities, but here are just a couple of regional highlights for you to consider. In Phoenix, 31% of the homes sold by investors in March sold at a loss. Remember, the average was about 15%. So what we're saying is that Phoenix, double that. So Phoenix is getting hit really hard and is the highest share of any metro area that is seeing big losses. Next came Las Vegas, Jacksonville, Florida, Sacramento, California, and Charlotte. Of all regions to see the least decline in investor purchases, it was Baltimore. It still fell 8.8% year over year, but that was the smallest decline, followed by Providence, Rhode Island, Seattle, Milwaukee, and Cleveland, Ohio. So what does all of this mean? Well, to me, first and foremost, investors are behaving like the rest of the housing market. Demand is slowing, the cost of capital is up, and as such, total sales volume is down. 2, the major change is that big investors are slowing down their investments, not smaller investors. Some companies have become net sellers, but it's really small, basically flat, and at this point, they are not dumping inventory, but we'll have to keep an eye on that. 3rd, I don't think that this means that there will be a crash on a national level, as I have been saying for months. Inventory and demand are dropping at the same time. This is the basics of economics. Yes, demand is dropping, but if supply drops at the same time, prices can hold firm, and that is what is happening, at least for now. 4th, for small investors, there is a good chance of declining competition, especially in iBuyer markets. So if you want to buy in a place like Charlotte or Atlanta or Phoenix, this could be a good time to do it. Now, note, these markets could be in a correction. Remember, I just said Phoenix is in a big correction, so you have to be careful. But it also means there might be less competition and there will be good deals to scoop up if you know what to look for and are able to analyze and identify those good deals. And I think this is really important because big investors, they're not going to stay away forever. This is probably a temporary pause while they figure out what's going on in the broader economy. These are well-funded companies with operational and financial means to pick back up very quickly. I think they're waiting for prices to drop a bit, and then they're probably going to come back into the market. So now could be a good time to buy. I'm not saying you should go buy anything, but if you are careful and identify motivated sellers and you can buy well below asking price, this could be a good time to buy. Make no mistake, there is big risk in this market, so you have to be careful. But with fewer buyers, better opportunities often arise. And if you're patient and focus on deals with strong long-term fundamentals, you could find yourself a winner. All right, thank you all so much for watching. I'm Dave Meyer with BiggerPockets, and I'll see you next week.